In this chapter, we will cover investments, and we will cover both types of investments, debt investments as well as stock investments. We will talk about the reasons why companies actually invest, and at the end we will talk about the different types of about the different levels of investment in companies and the use of consolidated financial statements. So why do companies in general invest? There are several reasons, and the main reasons why a company might invest in either debt or stocks of other companies, it is so, for example, to make use and to take advantage of the excess cash that they would have due to several reasons. For example, a ski resort might have most of their revenues during the winter season, but when come summer season, they might have a low need to sell products. As a result, this fluctuation in their revenues and in their business activities, they might end up with extra cash that is idle in a way, that is not being in use to buy products or to renovate or to pay utilities, etc. As a result, the company might decide to use this excess cash and invest it to generate additional revenues during the low season. It could also have to do with the economy. For example, if the economy is growing, if a company is doing well, they might also take advantage of the excess cash to invest it for rainy, basically to get extra cash for a rainy day. And when companies invest their excess cash for short, usually they do that for short periods of time, because they expect to need that cash later on. So for example, for the ski resort, they might need that cash right before the season starts, so that they would replenish their products, they would renovate, for example, expand their business, etc. So when companies invest excess cash for short periods of time, they usually invest in low-risk, highly liquid securities. Most of the time, they actually invest in short-term government securities to make sure that whenever they needed the cash, they can simply sell it and get the cash back. If they invest in a company stock where the stock price might fluctuate, when the time arrives when they need cash, and if they sell it at a low price, they would end up losing money. This is why most of these companies usually they invest in low risk, mostly short-term security, government securities. Now another reason, so that was the first reason, when companies have excess cash, and rather than just keeping it in the bank, they prefer to use it and to invest it in other companies or other basically in debt and stock securities. The other reason would be for if the main business is to invest money, this is to generate basically income, like banks, for example, and mutual funds. Their main line of business is to lend money and to invest and to buy stocks of other companies. And the third reason is where companies actually they might want to, for example, enter a new industry. They might want to have to exert certain control over their suppliers or customers, and we have seen that in many places where, for example, the company might invest in their suppliers so that those suppliers cannot supply their competitors. The same thing can be said about customers. So for example, a company might invest in their customers. In that case, the customers will not be able to buy those products from someone else. They would have to basically buy it from this company. They might also want to, basically, if they are trying to enter a new industry, like for example Procter & Gamble, when they bought Gillette, rather than actually starting from scratch, they buy a company, or they invest up to a certain extent in a company in order to basically gain from the experience of the company that they are buying, or to learn more about it. And this graph here actually shows, it shows us, for example, this is the regular operating cycle. Companies, they have their inventory, so they have inventory, they sell it, and then they collect their receivables, they collect the cash, and they use cash to buy inventory. But during a certain period of time, if the company has idle cash, again, for let's go back to the example of the ski resort, they might use or take advantage of this cash at this point here, make their investment and sell it before they actually need to use the cash to buy inventory again. So first we will talk about investing in debt. And when we talk about debt investments, this is basically when the company invests in other entities' bonds, whether it was government bonds or whether it was company bonds, etc., corporate bonds. So when companies invest in bonds, this is when the company buys someone else's bonds. The company is not buying their own bonds. Here we're not talking about redeeming or retiring their own bonds. We're talking about investing and taking advantage of the interest that other companies' bonds will generate. So when companies invest in bonds or in stocks, they are interested in the interest that is generated or in the dividends that stocks would earn them. So in this case, when companies invest in bonds, so for example, company A invested in company B's bonds, they would have to record the acquisition of bonds. So basically, there are three times when the company has to basically record. This is when the company acquires those bonds, when they buy those bonds, when the company earns interest from these bonds, as well as when the company eventually sells those bonds. When the company purchases bonds, the company will actually record it at cost. Here, the cost principle will apply. And again, like other assets, the cost would include all the expenditures that are, basically all the expenditures that are necessary to get this bond. So in this case, it could also include, in addition to the purchase price, it could include brokerage fees, etc. And bond interest, we have already basically done that. Usually this is where we multiply the interest rate by the time in years, and we multiply it by the carrying value. And the third one is when the company would sell the bond. In this case, the company will credit the investment account, and they will debit cash because for the amount that they received. And if there is any difference between the sales price and the purchase price, basically the net proceeds and the cost, it's not the purchase price and the cost. So between the net proceeds, if there were any fees, again, they have to be any brokerage fees, they have to be deducted. So basically it's the net proceeds minus cost. Any difference between net proceeds and costs will be recorded as a gain or loss. So let's see how we will see now how this will be actually recorded. Okay, so Cool Corporation acquires 50 Dawn Inc. 8% 10-year $1,000 bonds on January 1st, 2014 for $54,000, including brokerage fees of $1,000. The entry to record the investment. Here we're talking about the investment, and that means when the company actually buys those bonds. So the first thing is, on January 1st, the company will debit debt investments This is when they purchased the bonds for the whole cost. So this is, in this case, it's the cost is $54,000. It includes $1,000 fees. Because it's including the $1,000 fees, we don't add it. So they bought them for $54,000. So the company will debit debt investments $54,000 and will credit cash $54,000. Now these bonds pay interest semi-annually on July 1st and January 1st. So these will pay interest semi-annually, July 1st and January 1st. Here we need to make the journal entry for the receipt of interest. This is when the company will receive those interest on July 1st. Once again, when we calculate, in order to calculate the interest, it will be the face value. This is 50 bonds multiplied by $1,000 per bond, so it's 50,000 multiplied by 8% semi-annually, which is to mean 6/12, and that would be equal to 2,000 on July 1st. So this is the amount of money that the company will receive. So the company will debit cash 2,000 and will credit interest revenue 2,000. This is to record the revenue that the company earned from their interest, from the interest amount. Now, if Kool Corporation's fiscal year ends on December 31st, we need to prepare the entry to accrue for the accrued interest since July 1st. So this is to record accrued interest revenue. So in this case, of the accrued interest, it will be again the same amount, 2,000, but the company will not actually receive the money. Instead, the company will not debit cash. The company will debit interest receivable 2,000, and the company will credit interest revenue 2,000. This is to recognize the revenues for that period of time, the interest revenue for that period of time, although they did not receive the cash. Now, when the company receives the cash on January 1st, the company will debit cash 2,000 and credit interest receivable 2,000. Now, assume that Kool Corporation receives net proceeds of $58,000 on the sale of the Dawn Inc. bonds on January 1st, 2015, after receiving the interest due. We need to prepare the entry to record the sale of the bonds. So far we have recorded the purchase of the bond, basically a bond acquisition. Then we talked about interest, receipt of interest. And now we will talk about recording the sale of the bond. So this is to record the sale. At this point, the company will receive in cash $58,000. This is the amount of money that the company will receive net. This is the net proceeds. So the net proceeds are $58,000. As a result, the company will receive $58,000 in cash. So cash will be debited $58,000. This is based on the selling, based on the sale of the bonds. The company will credit debt investment, the cost. This is because it was recorded at cost originally, and the difference between the two is here because the amount of money that the company received for the sale of bonds exceeds the cost. The company will record a gain, and it will debit gain on sale of investments, the difference between the two. So this one is at cost, whereas this one is the difference between the two. So this is the difference between the two amounts. Pension funds and banks, they regularly invest in debt and stock securities in order to house excess cash until needed, generate earnings meet strategic goals or avoid a takeover by disgruntled investors? The answer is B. They usually do that to generate earnings. When bonds are sold, the gain or loss on sale is the difference between the sale price and the cost of the bonds, the net proceeds and the cost of the bonds, the sales price and the market value of the bonds, the net proceeds and the market value of the bonds. So it's not the sales price, so this one is incorrect. It is between the net proceeds and costs. If you remember, this is what we did in the previous in a couple of slides earlier. This is where we recorded a gain because the net proceeds exceeded cost. So when net proceeds exceed cost, the company will record a gain. When the net proceeds are less than cost, less than the cost of the bond, it will be recorded as a loss. Now we will talk about stock investments. This is when the company invests in another company's stocks. Here we are talking about, for example, Apple investing in Best Buy, or Google investing in Target, something like that. We're not talking about the same company about the company buying back their own stocks. As you remember, when a company buys their own stocks, that would be a treasury stock. Here we are talking about stock investments. So stock investments are investments in the capital stock of other corporations. And when a company holds stocks of several corporations, this group of securities is usually called an investment portfolio. This, when we talk about investment portfolio, it is simply a group of securities from other companies and other corporations. Basically, for example, it could be stocks or debts or a combination of stocks and bonds of different corporations. Now, with stock investments, it's a little bit different than debt investments. Stock investments, because it depends on how much, so the recording method and the reporting method of this investment depends on the percentage of ownership. When the company purchases or invests up to between 0 and 20%, the company will record it at cost. This is simply, at this point, it will be considered here. So in this case here, it will be considered as basically an investment. It will be considered as an asset. And in this case, the company is, the company's influence is not considered significant. So the company's the buying or the investing company will not have a significant influence on the investee, on the company where they are investing, and this is why it is expected to be a passive investment. On the other hand, when the company purchases up to between 20% and 50%, the company in this case is considered to be a minority active. The company has some influence on the other one. They don't control it completely, but there is a significant influence. Most probably, these people will also have, this company will also have someone on the board of directors of the company where they are investing. And usually, sometimes companies do that in order to, for example, have certain influence. For example, if it is for a supplier, again, like we mentioned before, to make sure that that supplier will only supply their company, etc. And here the accounting, like we said, depends on the extent of investors' influence. So the investor's influence will depend on the ownership percentage, because that percentage will affect how or the level of influence that the investor will have over the operations of the other company, as well as over financial affairs of the other company. So we will start with companies holding less than 20%. Here the companies were recorded at cost, and as you remember, the companies will record the investment at cost, and they will recognize revenue when they receive dividend. So it is when they receive cash dividend, they will recognize it as a revenue, and they will record it and they will also record the sale of the stock. Now again, as consistent with the cost principle, the cost will in this case the companies would have to record this asset at cost, and the cost would include all the expenditures that were involved, that the company had to pay in order to acquire those stocks. So that would also include, if there were any brokerage fees, they would have to be included in addition to the purchase price. So let's see how the companies record acquisition of stock investments of up to 20%. So on July 1st, 2014, Sanchez Corporation acquires 1,000 shares, which amounts to 10% ownership of Beal Corporation common stock. Sanchez pays $40 per share plus brokerage fees of $500. The entry for the purchase will be, remember here the company paid $40 per share plus brokerage fees of $500. So the amount of cash that the company paid will be 1,000 shares multiplied by $40, and that would be 40. This is the purchase price, 40,000. Add to that the $500 brokerage. So this is the amount of money that the company actually paid, and the company will debit stock investment 40,500, and the company will credit cash 40,500. So this one is reported at cost. So this is recorded at cost. Now that was to record the purchase, or that was to record the investment, the purchase of the stocks. When the company later on receives dividends, they need to also record the dividends that they earned. In this case, during the time Sanchez owns the stock, which were $1,000 shares, it makes entry for any cash dividends received. If Sanchez receives a $2 per share, so the company received $2 per share, that is $2,000, the company will receive, on December 31st, the company will receive $2,000 in cash, so it will debit cash $2,000. At the same time, the company will record this as a dividend revenue, so the company will credit dividend revenue. So this is to record the dividend revenue that the company earned from their investments. And Sanchez will report dividend revenue under other revenues and gains in the income statement. This is in the same way as the company would report also interest revenue. However, unlike interest on notes and on bonds, dividends, they do not accrue. If you remember, we said that dividends, they are only they don't accrue. It is only when the company declares dividends that the company would later on, and they receive it, they will later on, so the investors at that point will record the revenue, the dividend revenue that they received. So in this case, companies, they do not make any adjusting entries to accrue dividends, unlike the interest. Remember, we did interest, we made a journal entry to record accrued interest, but we don't make a journal entry because for dividends, because dividends, they don't accrue. Now the last part is when the company sells those stocks. So assume that Sanchez Corporation receives net proceeds of $39,500 on the sale of its Beal stock on February 10, 2015. Because the stock cost $40,500, in this case, Sanchez has incurred a loss. So that was at cost. This is the cost. This is the cost here. That's the cost. Here, those are the net proceeds. The proceeds were $39,500. This is the amount of money that the company will receive. So the company will debit cash $39,500. This is always based on the proceeds of sale. The company will credit stock investment at cost. The difference between the two will be debited to loss on sale of investments. If the company had sold the stocks for a price higher than the actual cost, the company would have credited gain on sale of investments. So this is the difference between the two, and because it's a loss, the company will debit loss, and once again loss will be reported under other expenses and losses on the income statement. Okay, so when the company, now we move on to when the company has invests between 20% and 50%. Once again, this is considered as minority active shareholder, because the company has a significant influence on the company they are investing in. However, they still don't control it completely. And because now they are a major shareholder of the other company, the equity method is used. And the idea here is that now they are not just investors who are looking at earning the dividends. They are actually making part of they are shareholders. So for example, if the company is investing 30%, it means that any earnings that the other company makes during a certain year, they will earn 30% from that one. So here the idea is that the investors' share of the earnings or the loss will be also significant compared to, for example, in the previous part. So their share of the earnings and or losses, basically the company earns basically of the net income or net loss, is significant. And this is also in addition to the dividends. So however, the company in this case will not just look at the dividends. It's more the whole net income that the company, part of the net income that the company is receiving. So to say it differently, when an investor owns between 20% and 50% of the common stock of another corporation, the assumption here is that the investor will probably have a representative on the board, which is to mean that they will have also some control, not complete total control, but at least some control over the investee. And in this case, it makes more sense that the equity method would be used, because at this point the investor will record this. Basically, the investor will be looking at this as part of their the earnings. So here, the investor company initially records the investment in common stock at cost. This is originally when the company actually receives it. When the company purchases or makes the investment, they will record the common stock at cost. But after that, it will make adjustments to the investment account every year to show the investors' equity the change in the investor's equity in the investee. So basically every year the investor will increase the investment account by debiting it, and will also increase revenues, because at this point the company has earned part of those revenues. And then the company will they will decrease the investment amount for the amount of dividends that they have received. And let's see why this is done. So basically think about it this way. Let's say that company A invested in 30% in company B. Company B in 2014 earned, let's say the net income was equal to $100,000. Company A's share of it, so A's share of this one is equal to 30%, so it's 30% of 100,000. However, so this is basically if company B did not pay any dividends. Now let's say that company B instead they also paid dividends. So the company B paid dividends for, let's say, dividends for 10,000. So dividends were equal to 10,000. Once again, A's share of this dividend. So the company's retained earnings now are equal to 100,000 minus 10,000. Again, this is for B. This is for company B. So this is equal to 90,000. Company A's part of it will be equal to 30% of retained earnings, and this will be equal to 30% of 90,000. So how do we calculate this? Usually we put cost, we add earnings, and we subtract dividends, the dividend that the company received. So here it's the same thing. The company, the cost is always the same. This is the amount that the company originally recorded. And then the adjustment every year will be for the earnings minus dividends. And again, this is basically to get to retained earnings. Here, the company, so the company will have to subtract dividends. Here, it is the same as if the company got the 30% of net income minus the dividend that they received, because the amount of dividends that they will receive is also 30% of the dividend. This is their share of the dividend. So at this point, the company will be recording the earnings minus, so their part of net income, and then they will subtract the dividend that they received. So let's look at an example here. Mylar Corporation acquires 30% of the common shares of Beck Company for $120,000 on January 1st, 2014. For 2014, Beck reports net income of $100,000 and paid dividends of $40,000. We need to prepare the journal entry for these transactions. So the first one is when the company acquired the stocks. This is when the company purchased the stocks and the cost was 120,000. So the company will debit stock investment 120,000 and will credit cash 120,000. The second entry will be to report their share of net income. So the share of net income that the company will receive will be 30% of 100,000. So the company will debit. However, the company will debit that amount not to net income because it's not Myler's net income. Here we are doing that for Myler. So Myler cannot report these as their own net income. Instead, they will debit it to stock investments. Basically, now their equity in the other company has increased by 30,000, and they will at this point they will credit revenue from investments 30,000. So they will recognize the revenue, but they don't receive it in cash. Their value of their investment has increased. So this is, here it's important, value of investment has increased. They did not receive the cash. The amount of cash that they actually received was the dividend of their share of the dividend, which is 40,000. It's 30% of 40,000. So the company will debit cash 30% of 40,000. That's $12,000, and that would be credited against stock investments. So stock investments will be credited. And the reason we do that, this is not, at this point, we're not recording it as just dividend revenue. Those two together, it's as if the company has received, so this is saying basically that the company has received 30% of BEC's retained earnings, but the company did not actually receive that in cash, the total amount, but their investment has increased by that amount, and they received the cash only for the dividend part. However, the value of their stock investment has increased by 30% of retained earnings, which is, as you can see here, it will eventually be 30,000 minus 12,000, and that would be 18,000. Which is the same as their share of retained earnings, which is 30% of 100,000 net income minus 40,000 dividends that the company paid. So, and this is after Myler posts those transactions, the amount that counts will look like this. So stock investment, originally the company, well, this is when the company purchased it. So this is when the company purchased it, and then we have when the company later on recorded their share of the earnings. So this is from the net income from BEC's their share from the earnings, and this one is when they credited the amount because of to deduct the dividend that they received. So this is because of the dividends. As far as revenue is concerned, the revenue from the stock investments, this is their share, which was 30,000. Now, under the equity method, and here, the account, in this case, the account that was credited here, the account that was debited, we had debited cash, if you remember from the previous slide. Now, under the equity method, the investor records dividends received by crediting which account? Dividend revenue, investment income, revenue from investment, or stock investments. Remember that when the company are recording the dividends that they receive, they will debit cash and they will credit stock investments, because it is actually decreasing the value of their equity in the other company. Remember, now it's not just a dividend revenue. This dividend will be decreasing their share of the other in the other company. So now we get to the situation where the company actually holds more than 50%. This is when the company has a controlling interest. It is actually controlling the other company. They have the majority of the votes. They basically they control the operations of the company, etc. And at this point, the investor becomes the parent. The investor at this point is called the parent, and the investee is called the subsidiary. At this point, according on the there will be basically the company, the parent company will still record on their books this investment as a long-term investment, but then the parent will also, so it will be recorded on the books as long-term investment, but the parent usually also prepares consolidated financial statements. We'll talk about that later on. In consolidated financial statements, this is when the company prepares a financial statement as if all the companies that are controlled by the parent company, which is to mean it's the parent and all its subsidiaries, as if they were just one big entity. So this is in addition to the financial statements prepared by the parent company and the subsidiary company. There will be an additional consolidated financial statement. So just to give you an example here, for example, Procter & Gamble, they purchased Gillette. It is important to understand here that Procter & Gamble will only take into consideration basically here Procter & Gamble's shareholders will elect Procter & Gamble's board of directors. So here the board of directors, they also control, because they are the majority. So the company here becomes, this is the majority of the shareholders of Gillette. As a result, they basically elect the board of directors of Gillette as well. Because they control it, they will also control the board of directors of the subsidiary, which is Gillette in this case. And those people will control the company. So basically, this is the board of directors of Procter & Gamble will control Procter & Gamble's, naturally, as well as the subsidiary, because they also control their board of directors. So in this case, later on, the company will prepare. So the Procter & Gamble will be preparing later on financial statement for their own records and for their own earnings, etc. Because those are two separate legal entities. You have two companies here. However, economically speaking, they become like a single economic entity. This is why companies would also, like Procter & Gamble eventually will also prepare a consolidated financial statement, because each one of these will prepare a financial statement, this one and this one, and at the same time we have Procter & Gamble who will be later on preparing a consolidated financial statements, as if the whole thing was just one big single economic entity. Now, so far we have talked about the three levels of or percentages of ownership. Now we will talk about how companies value and report investments, both debt investments as well as stock investments. So there are basically different categories of securities. We can have trading securities. Those could be either debts or stocks. We have held for collection securities. Those are debts. If you remember, held to maturity bonds. Those are only work for debts. And we also have non-trading securities. Those are stocks where the company when the company invests in another company, but the main idea here is that this is not for trading purposes. This is for other purposes. For example, to have certain influence, to get into the industry, etc. And here, those are more of guidelines where the company needs to actually use their own better judgment for that. And this works for companies where for cases where the company has basically when the investment is for less than 20%, because after that it becomes equity, and they become also some basically later on they become controlling groups. So here in this case, now it is important to in this case it is important to basically make sure that we are valuing them and reporting investments at the correct method, because valuation could be done at cost, at fair value, or at lower of cost or market, like we did with assets. And so this is why it is important to know which one actually is the correct one, because prices also fluctuate. So when you are buying when buying a bond or a stock, the price, the market value or the fair value will change and will fluctuate all the time. So it is important to know which value to use to report it. Trading securities are usually bought and held mainly for sale. So this is again to talk about the three types of the three categories of securities. Trading securities, it is important to remember that they are bought and held to mainly for sale in a short period of time. So this is not to be done for a long period this is for a short period of time, whereas held for maturity, this is again like we talked before about bonds. Non-trading securities, those are stock investments that basically that are held for purposes that are not trading. So trading securities are the stocks or debts that the company invests in, and that the company buys them with the intention to sell them in a short period of time. As a result, the company will report them at fair value. And at that time, the company will also report changes from cost. Remember that when the company originally buys them, it will record them at cost, and then later on, the company will report the changes from cost as part of net income. That would be either that would be later on either a gain or a loss. However, before selling them, if the company has to prepare the books before selling them, the company will report either unrealized gain or unrealized loss under other revenues and gains, or under other expenses and losses. So this is the idea here, is that the company, let's say that the company bought certain bonds at $400,000, and then on December 31st, the company found that the value for these ones were actually the fair the fair value, or the market value, was $105,000. The company did not sell them, so the company cannot recognize a gain on the sale of those securities. But the company wants the company will need to report that the value has changed. As a result, the company will report on the income statement a $5,000 as unrealized gain. It is unrealized because the company did not sell them. The company did not actually make the gain. But if the company were to actually sell them on December 31st, the company would have reported a gain of $5,000. And remember that trading securities, those are classified usually as current assets, because the company intends to liquefy them within a short period of time. So let's see, for example, how this is recorded. Investment of PACE classified as trading securities on December 31st. So the company has invested in those two, in Yorkville Company bonds and Kodak Company stock. We have the cost values and we have the fair value. So the total amount, the total cost was $140,000. The total fair value was $147,000. And those were classified as trading securities, which is to mean that the company intends to sell them in a short period of time. So those were reported as current assets. And the company here, it will basically the company here will sell them for the company here, the difference between the two is $7,000. Because the fair value is higher than cost, the company will report unrealized gain, and that would be an unrealized gain on the net income. However, the adjusting entry, so remember that the company will always report them at so the company reported them originally at cost. Now the company has to make an adjusting entry so that it would report them as fair value. Remember, we said that basically assets are to be we continue to report assets at cost, except for very few types of assets, and those are securities. So those are, in this case, like trading securities. They will be reported at fair value. So in this case, the company will debit fair value adjustment for trading. This is the adjustment. We need to debit it, $7,000, to increase the value of that asset, and then the company will credit unrealized gain income. And the word here we put income is to indicate that this has affected the income statement. As a result, we credited to unrealized gain. Remember that the company did not actually make that gain. They did not make the sale. They did not sell those assets. But if they were to sell it, they would make $7,000 in gain. So here, the use of fair value adjustment from trading account, it enables the company to maintain a record of the investment cost. Here, because it will allow the company to know the original cost as well as the adjustment. So it needs actual cost. The company will need actual cost to determine the gain or loss realized when it is actually sold later on. Remember, when the company later on makes a sale, the company will be debiting the investment account at cost, not at fair value, at cost. So this is why the company needs to keep track of the cost. So PACE at that point adds the debit balance of, like in this case here, the company will add this debit balance. It will add it to the cost, and if it were a credit, because if it were a loss, the company would have debited loss and credited fair value adjustment from trading. The company, like in this specific example, the company has debited fair value adjustment, and as a result, it will add it to the cost so that they would arrive to the fair value. We have here this one plus this one, and the two together will be equal to the fair value, which is used for reporting purposes. So the fair value of the securities is the amount that the company will actually report on the balance sheet. The unrealized gain in the income statement the unrealized gain is reported in the income statement as other revenues and gains section. And the term here, income, it simply means that this account will indicates that the gain would affect net income. Now, if the total cost of the trading securities is greater than the total fair value, there will be an unrealized loss, and in that case, the company, like we said, the company will debit unrealized loss income and credit fair value adjustment trading. And we will see later on, because there is also another account that is called fair value adjustment for non-trading securities. So the companies report unrealized loss under other expenses and losses. Now, the companies, they don't actually recognize the loss, because the company did not sell those securities at that point. And the fair value adjustment trading account is carried forward in the future accounting period, and every time that the company, so this is not closed, and every time that the company every time that the company prepares the financial statements, they make the entry. But during the year, they don't make any entry to the account until the end of that accounting period, when they want to actually adjust the value for reporting purposes. At that time, the company will adjust the balance in the account to the difference between the cost and fair value. So every time there will be a change in the cost, to adjust from the cost to the fair value. So that was for trading securities. Now, for non-trading securities, these can be reported either they could be reported either as current assets or as long-term assets. That would depend on whether the company intends to sell them within 1 year or not. So once again, within 1 year or one operating cycle, the company will, if the company intends to sell them within 1 year or one operating cycle, it will classify them as current assets. Otherwise, the company will report them as long-term assets. And here again, in order to determine the fair value, we do the same thing as non-trading as we did with trading securities. However, the company will report in a separate component so the company will report securities at fair value, but they will report the change in a separate component of the stockholders' equity section. They will not use net income. So it's not like with trading securities. We added unrealized gain and unrealized loss to the income statement. Here, the company will report those changes directly to the stockholders' equity section of the balance sheet. So let's see how this is done. Assume that Ingrao Corporation has two securities that it classifies as non-trading, and this is the information. So there are two. The company has, this is cost, this is fair value on December 31st. The company is not selling those stocks yet, those securities yet. So those stocks, this is why we use either unrealized gain or loss. In this case, because the value of the fair value is lower than the cost, this is reported as unrealized loss. So what's the journal entry that the company will need to make? The company will debit unrealized gain or loss from equity 9,537, and the company will credit fair value adjustment non-trading the same amount. Here the company, as you remember, you know, this is mentions here equity because this will be reported on the stockholders equity section and not on the income statement. So it's not going to affect the income statement. And fair value adjustment for non-trading, again, to differentiate it from the fair value adjustment for trading securities. So as you can see here, both the adjusting entry and the reporting of unrealized gain or loss for the company will differ from non-trading securities from those that when we use trading securities. The differences result because the company, Ingrao, here the company who is investing, they don't expect to sell these securities in the near future. As a result, prior to the actual sale, the company, well, the price of the changes in the fair value, it is more likely that the changes in the fair value may change either unrealized gains or losses. So by the time they actually sell it, this change will not be maybe changed completely. So although here we have an unrealized loss of 9,537, by the time the company actually sells those securities, the price, or basically the fair value, might have changed a lot. So this is why the company will not report unrealized gain or loss on the income statement, to avoid unnecessary fluctuations. And for non-trading securities, the company carries forward the unrealized gain or loss equity account to future periods. And in the same way, at the end, whenever the company prepares financial statements, they will make the adjustment to fair value. They make the adjustment so that they would get to the fair value. So they use fair value adjustment from non-trading, and they will also make the adjustments to unrealized gain or loss equity accounts to show the differences between the cost and the fair value at that time, at the time of the preparation of the balance sheet. Remember that in this case, the company will make the adjustment to those two accounts here, to this one, to this one, and to this one, when they prepare financial statements in the future. So an unrealized loss on non-trading securities is reported under other expenses and losses in the income statement, closed out at the end of the accounting period. It is reported as a separate component of stockholders' equity or is deducted from the cost of investment. So this is unrealized loss on non-trading securities. As a result, this is reported as a separate component of the stockholders' equity. Now, the one that will be reported under other expenses and losses will be unrealized loss from trading securities. And unrealized loss on non-trading securities, it is carried away. So this one will be carried away, carried basically with, it will be carried over into the future accounting periods. The account will be adjusted at the end of each accounting period to get to the fair value of the securities. So short-term investments, they also call them marketable securities. So marketable securities are called as such because they must have these two characteristics. They have to be readily marketable. They can be sold basically immediately. Those are the bonds and stocks that are traded. For example, like bonds and stocks that are traded, that are actively traded, and they are intended to be converted into cash within the next year or operating cycle. So they must have those two characteristics to be classified as marketable securities, and those are because they are highly liquid, because they can be turned into cash readily. They are usually reported right after cash under current assets, and they are reported at fair value because, once again, those are securities are recorded at fair value, and this is basically if it is below 20%. Here, remember that those classifications are mostly for investments where we have below 20% of the investee. And here, investments that do not meet both criteria will be classified as long-term investments, and they will be reported as a separate section of the balance sheet. They will not be reported under current assets. They will be simply a different section after current assets. So we will have current assets, we have cash, short-term investments, etc. And then later on, and then next, we will have another section that is called long-term investments. Remember, for short-term investments, they have to be readily marketable. For example, publicly held companies that are where the stock is actively traded on the securities exchange markets, and the company must have the intention of converting them into cash within 1 year. So marketable securities bought and held primarily for sale in the near term will be classified as, of course, they will be classified as trading securities, because those the company intends to sell them within 1 year. Now how does the company present them and report those items on the financial statements? Realized and unrealized gain or loss will be reported under non-operating activities section on the income statement. As you remember, those will be, so loss will be under other expenses and losses, whether it was a loss on sale of investments or unrealized loss income. Remember, this is unrealized loss income. This is not the one from this is not unrealized gain or loss equity. This is from trading securities. So this is unrealized loss income, unrealized gain income, Again, those this is from trading securities. So here we have, under other revenues and gains, we will also have gain on sale of investments, and we will have unrealized gain income. For non-trading securities, it's not going to be on the income statement. As you remember, for non-trading securities, unrealized gain or loss, it will be reported under the stockholders' equity section as a separate component. Now, for non-trading securities, like we just mentioned, it will be a separate component. And let's see how this works. Assume that Dawson Inc. has common stock of $3 million, retained earnings of $1,500,000, and an unrealized loss on non-trading securities of $100,000. The company will, this is how the company will report them. Basically, the company will have, this is stockholders' equity. So this is the stockholders' equity part. We have, again, common stock, we have retained earnings, and then we have, after the paid-in capital and retained earnings, we have less unrealized loss on non-trading securities. If we had a gain, it would be unrealized gain on non-trading securities. Here, because the company has a loss. And reporting the unrealized gain or loss in the stockholders' equity section, it serves two objectives. First, it reduces the volatility of net income, because the fair value fluctuates a lot. The actual gain or loss that is expected will fluctuate a lot, because those are non-trading securities, so the company does not expect to sell them anytime soon. And in order to avoid this volatility in net income, the company will still need to report them, but they will report them on the balance sheet, because it needs to inform this financial statement user that there is a potential of gain or loss that will occur if the company was to sell those, if the company were to sell those stocks today. And this is how the balance sheet, the partial balance sheet, looks like for the current assets. So we have current assets. Under that, we have, of course, first is cash, and next is short-term investments at fair value. So the companies will not only report the short-term, the value of the short-term investments, it also reports at which, basically, the method of valuation. Here it is at fair value. And then under investments, those are long-term investments. The company will also report the type of investment. So this is an investment in stock of less than 20%. So this is also the percentage of ownership. This is the percentage of ownership. And then it also reports the valuation method. And the second one is 20 to 50%. And it is reported at equity. So the company will also report the valuation method. It is important to do that. So let's see how we can classify each item, and we'll see also under which on which financial statement it goes. So interest earned on investments in bonds. This is the interest that the company will earn on investment in bonds. So it will go on the income statement, and it will be reported as other revenues and gains. Fair value adjustment, non-trading. This will go on the balance sheet, and it will go into the investments part. Unrealized loss on non-trading securities. Remember, this is again unrealized loss on non-trading securities, so it will not go to the on the income statement. It will go on the balance sheet as under the stockholders' equity, as a separate component on the stockholders' equity section. Gain on sale of investments in stock, the company will report it on the income statement as other revenues and gains. And remember, this is a realized gain because the stocks were sold. Unrealized gain on trading securities, it will also go on the income statement under other revenues and gains, although it is a different account. Randy Corporation's trading portfolio at the end of the year is as follows. Security, it has basically the company has two stocks, stock A and stock B, and we have the cost as well as the fair value. Randy subsequently sells stock B for $10,000. What entry is made to record the sale? So the company is selling stock B, okay, for $10,000. Here the company the sales price, so the company will be receiving $10,000 in cash. The company will debit cash $10,000, but the company will credit stock B at cost at $9,000. Remember, this is why we use the fair value adjustment account in order to keep track of the cost. So the company will debit stock investments, will debit cash $10,000. The company will credit stock investment $9,000, and the difference between the two will be the gain of the gain on sale. So this one is based on the proceeds from the sale. The stock investment will be credited based on basically based on the cost, and the difference will be either debited or credited to gain or to loss. So this one is the difference. Don't make the mistake of using the fair value, because in this case the company will be the company will record a gain or loss, the difference between the amount of money that they received and the amount of money that they had originally paid. Nadia Corp has common stock of 5,500,000, retained earnings of 3 million, unrealized gains on trading securities of 100,000, and unrealized losses on non-trading securities of 200,000. What is the total amount of stockholders' equity? So remember that stockholders' equity will be equal to common stock plus retained earnings, right? In this case, we need also to include unrealized gains or unrealized losses, but we don't include unrealized gains on trading securities. That one will go on this account here, will go on the income statement. So this one will actually go on the income statement, and not on the balance sheet. This one, on the other hand, goes, because it is on for non-trading, this one will go on the stockholders equity section on the balance sheet. So this one, it will be plus unrealized gain or loss. So unrealized gain or loss from non-trading. As a result, it will be 5,500,000 plus 100,000 So plus 3 million plus the 200, which is this amount here, this is the 200,000. Remember, the 100,000 will not be included, and that would be equal to 8,300,000. If a company acquires 40% common stock interest in another company, which method will be used? Is it the equity method that is usually applicable? All influence is classified as controlling. The cost method is usually applicable, or the ability to exert, basically there is no significant influence. Here the answer will be A, because at this point the company is a minority active shareholder. They have certain influence, so in this case it is not all the influence, it's not controlling. This is controlling, will have to be over 50%. The cost method is when we have less than 20%. This is between 20% and 40%. And the ability to exert is non-existent. This is not correct, because at this point the company still has some significant influence, although it is not a controlling influence. So now we will talk about consolidated balance sheets. With the objective in a consolidated balance sheet is to show the obligations to and the receivable from parties who are not part of the affiliated group. So the idea here is that we need to look at the company's debts to other outsiders, outside entities, as well as any money that the company, any receivables that the company expects to receive from parties who are outside the company and its subsidiaries. So here it is usually done so that basically to give us an idea of the parent company and its subsidiaries as one economic entity. Like going back to the example of Procter & Gamble and Gillette, it's not going to be only for Procter & Gamble or just Gillette. It is for Procter & Gamble and Gillette and all the other companies that are owned by Procter & Gamble. Here the company will the parent company will not be using the subsidiaries companies ledger accounts. So they will not start from the ledger accounts. They will simply take the financial statements of the subsidiaries and prepare the consolidated statements. Again, Procter & Gamble will not prepare the consolidated financial statement using the general ledger of Gillette. They will use the financial statement of Gillette and prepare the consolidated financial statement. Any transactions that happen between Procter & Gamble and Gillette, between the parent and the subsidiary, will have to be eliminated. Any transactions between affiliated companies, which are also called intercompany transactions, will have to be eliminated. They will have to be removed, because in this case we are only looking at any transactions with the outside world. And here it is very important to remove those intercompany transactions, because we don't want to overstate the assets and liabilities and stockholders' equity. Otherwise, the same accounts could be mentioned twice, for example, and we will see in a few seconds how this can happen. So for example, assume that on January 1st, 2014, Powers Construction Company pays $150,000 in cash for 100% of Certo Brick Company's common stock. So here the company basically purchased the whole company, and it became, this is the parent company and this is the subsidiary company. So this is parent, this is subsidiary. Powers Company records the investment at cost. This is when the company purchased it. The company is making, Powers making an investment. They paid $150,000 in cash, so the company will debit the investment account at cost, which is $150,000, and will credit cash $150,000. So on the balance sheet, the company will report this as an asset for the value of $150,000 according to the cost principle. But the combined totals, well, we'll see in a second that the combined totals on the financial statement will not be simply an addition of the two accounts. So if you look at this one here, the combined data is not actually the consolidated data. Here, total assets shows as $750,000, whereas the consolidated data is $600,000. And the reason for that is that the company here, when the company is, they are preparing their financial statements, the company, as you can see here, this is basically the financial statement of Powers Company. This one here. This part here is Certo Company. So these are the financial statements of each company separately. And then we have the combined data. The combined data is simply the sum of the two, but this is not the consolidated data. You see this amount here, which was reported on Powers Company's balance sheet. This is an intercompany transaction. This is an investment between that Powers made into the other company, which is Certo. As a result, it has to be eliminated. So the balances in the consolidated data column are the amount that should appear in the consolidated balance sheet. The double counting has to be eliminated. This one was double counted. Another thing that was double counted is also appears here. Those two, basically the common stock, has to be removed, as well as the retained earnings have to be removed, because now they became part of Powers Company's of the stockholders' equity of Powers Company. So they are included in the equity of Powers Company in Certo. As a result, the value here, it will be, what we did here is that we eliminated the intercompany eliminations would be by removing the investment amount, as well as removing the stockholders' equity part of Certo Company, and only keeping stockholders' equities part of Powers Company, because now this is the when we look at the whole consolidated part of it, we will look at the whole thing as one entity. This amount here is already owned by the company, so those are those two amounts here, they are the same. Now, it is very common for companies to use a worksheet that helps accountants to do those intercompany eliminations. So here the worksheet, again, it will list the accounts, the balance sheet items of each company, and then they will then we make the eliminations, to get to the consolidated data. This is our objective. This is those are the values that will be reported on the consolidated balance sheet of Powers Company and Certo Company. So the here we can see that the cost of investment, which is 150,000, it's an asset. So in order to basically zero this amount, what the company will do is the company will credit this amount. In the elimination, the company will credit the investment account by 150,000 here in order to zero this amount, and at the same time the company will debit common stock and retained earnings account from Certo Company. So those two are basically this one and this one. This is to eliminate the investment. It is very important to understand that the companies, they only make intercompany eliminations on the worksheet, and only so that they would present the consolidated data, only so that they would get to the consolidated data. They do not post or generalize those eliminations to their journal ledgers or to their journals or to their general ledgers. So those are not actually posted or generalized. This is only done on the worksheet in order to get to the consolidated data. As a result, those eliminations, they do not affect the ledger accounts. They will not make any real changes. This is only done on the worksheet to get to the consolidated data, and the important thing is that we need to get eventually, as you can see here, the consolidated data is not simply the combined data of the two. Now, at that point, the one that we just used, we had the cost was equal to the book value. So the cost of acquiring common stock of another company, it can be above or below the book value. This has nothing to, like we saw before, the book value is the value of the company on the according to the company's records, whereas the actual cost of acquiring a company, it will also depend on the negotiations between the acquirer, between the parent company, and, for example, in this example, between Powers and Certo. So the management of the parent company may pay more than the book value for the stock for different reasons. It could be, for example, that they believe that the fair value of identifiable assets, so for example they believe that the book value of the buildings or of the lands are actually higher than the fair value of a certain building or a certain land are higher than their book value. As a result, they know that the value of those assets are higher, and they might be willing to pay more than the book value when they acquire the company. And they could also be paying the difference because they believe in the subsidiary's future earnings, that they might be making more money. As a result, they will pay more for goodwill. This is where, as you remember, we talked about goodwill. It is in this case where we will see it. So let's see how this works. Assume that the same data was used as before, except that Powers paid 165,000 in cash for 100,000. So here the company paid 165,000 to acquire Certo instead of 150,000. The excess of cost will be 15,000 because according to the book value, so this is the book value, this one is the cost of acquiring them. So this was the book value, and this one, and 165 is the cost. Let's look at the worksheet here. So the company will again eliminate. So this is the amount that the company paid. The intercompany eliminations will include a credit to the investment account, a debit to common stock and to retained earnings of certain company, and the difference between the two is debited to excess of cost over book value. As a result, the total assets will be equal to total liabilities and stockholders' equity. It is important to keep that in mind. Don't ever forget the accounting equation. So here we have, again, we also have total debits are equal to total credits, 165,000. So what happens here, we need to see also how the company will account for this 15,000. So this is what we call the content of the consolidated balance sheet. So the prior worksheet shows an excess of cost over book value of 15,000. In the consolidated balance sheet, Powers first allocates this amount to specific assets such as inventory and plant equipment if their fair market value on the acquisition date exceed their book value. Any remainder is considered to be goodwill. So for here, what we're saying simply is that the company will look at this excess. It is this excess of cost over book value is 15,000. If they know specifically that a certain asset account, that the fair value of a certain asset account exceeds the book value, they will allocate that amount to that specific asset account. If they don't, or whatever remains will be considered goodwill. So for certain company, assume that the fair market value of property and equipment is 155,000. So instead of 100 and this one here, instead of 145, let's assume that this is the book value. The book value of PPE is 145,000 net. Instead, let's say that the value is 155,000 net. So Powers allocates 10,000 of the excess of cost over book value to PPE, and the remaining 5,000 will be allocated to goodwill. So the company will show this this financial statement. It will be, this is the consolidated financial statement. So I'm going to use this color here, the consolidated balance sheet. That's a weird circle. That's a weird oval. Anyways. So the company here has the current assets, basically the consolidated amount. Again, this is the consolidated amount. The current asset, it will be, the current asset will be based on the current assets of the two companies. It will be the sum of the two companies. So it's 115,000 for the current assets. Plant and equipment, so PPE is 480,000, and 480,000 is basically the 470 plus 10,000. So this is 470,000 plus the 10,000 from excess, from the excess of cost over value of over book value. And then we also have here the remaining amount of 5,000 will be goodwill. So the remaining amount will be goodwill, and once again we get to total assets equal total liabilities and stockholders equity. As you can, this is in this case the company has allocated 10,000 to PPE because they know that their value is their fair value is higher than the book value, and the remaining amount was allocated to goodwill. Now the consolidated income statement, it serves the same objective. Companies use it to show the basically the earnings of the companies as if they were one economic entity, and once again any revenues and expenses between the affiliated companies will be eliminated. Any intercompany transactions in this case also are to be eliminated, and the companies usually also use a worksheet to prepare the consolidated income statement, which we will not show here. We only show the consolidated balance sheet, but the companies also use a worksheet to prepare a consolidated income statement in the same way. With this, we come to the end of this chapter, and in this chapter, as you remember, we have covered stocks, stock investments, debt investments. We also talked about consolidated income statement.